Let's get more on the markets from Ryan Belanger, founder and managing principal at Claro Advisors. Ryan, great to see you. When you get out of bed in the morning, what's the first thing you check in the markets?
Well, it's usually just what data might have come out, but we're more long-term investors, so I don't tend to look at anything too specific in the morning. I like to read my papers and kind of get acclimated for the day, and yeah, that's usually where I start.
What's your feeling about the markets? They're at or near record highs. Is there too much optimism about AI?
Oh, certainly. I think that the future of this is so unknown. And yet everyone seems so convinced that they need to spend massive amounts of CapEx to stay in this race. But the yield on this is just unknown. And so I think there's a lot of speculation in there. Certainly, there's a lot of productivity that is coming and has come from certain uses of AI. But yeah, it's a promised land, and we'll see if it can deliver. Certainly, companies are pouring a lot of their cash flow, into the future that they think will pay off for their shareholders.
It's interesting you say. I mean, given President Trump's trade war and other economic uncertainty, well, I guess the U.S. government shutdown is a ritual that Washington goes through every so often. But you say that looking at the headlines, you think the market might be down 10 to 20% this year.
Well, I just think, yeah, that's the feeling is it's pessimistic. It's doom and gloom, and that's certainly how it started. And the reality, though, is the investors doing great. It's fantastic. You've got another double-digit year for U.S. U.S. equities, especially large cap. I'm talking S&P. Certainly, the mid cap and small cap have not fared as well. But if you're in gold or crypto, you're doing fantastic as well. And what about the international investors? The lost and forgotten few that stayed true to their allocation to international over the last 15 years, just getting crushed by the U.S. And now those investors have been deeply rewarded, huge returns internationally. So I'm so happy for those of us that have stayed with our international allocations because that's really paid off this year.
So just to loop back to the U.S. tech stocks, you say massive amounts are being poured into AI-related investments, data centers, et cetera. But you see the momentum for the tech sector continuing?
I think it is. I mean, it's clearly risk on there. Certainly there's these similarities between the late 90s, the dot-com crash, which we invested through, but it is different. These are mature, cash flow heavy companies that are they're not speculative. It's not just a website. So I think there's legs to it. There's certainly a lot of, like I said, productivity that's going to be coming out of this, and I think that's really good for the overall economy too. And if we're looking at how do we get out of this the fiscal mess, certainly productivity would help us quite a bit. And that's our view is what's happening is the market's pricing in that people are just going to get really much more productive. And if that happens, companies can continue to keep their prices where they are, but actually expand their margins. That lets the Fed lower their rates. A lot of good things come from an increase in productivity.
So we're in an environment where the Fed is cutting rates. I mean, another cut is expected. And you say when the Fed does that, during non-recessionary times, the market typically does well?
Yeah, if you look historically, if you get non-recessionary rate cuts, equities are typically up 12% the following 12 months. Bonds are up 7%. So if I'm an investor, I'm thinking that's great. I just got a rate cut. My next year should be good, but we know it's never that simple. Investors have to really understand what they own in their portfolios. I think one trap people are getting into is just how much concentration they have, especially in those top 5, 6, 7 stocks. We went back and looked, in the early 60s, the top 5% or the top 5 stocks in the index only made up 11% of the index. It was AT&T, Exxon, and GM. And now the top 5 are 30%. So it's significantly more a concentration. So if we do see the AI not play out as we thought it was going to do, and the proliferation of passive investing, I think you could see a market where things get bad quickly because those top names are they make up so much of the index that the other 495 companies, as we're seeing today, just wildly divergent returns.
But I guess what will break that paradigm? Because of course, investors loading into the into those big Mag 7 stocks or even the biggest 5, and that pushes up the index. And of course, people, if they want to buy the index, put more money into the heavily weighted stocks. What could decisively break the cycle, do you think, Ryan?
Well, getting out of the passive versus active, certainly if active investors start performing better, people will start chasing active managers again. But what would happen to break the AI cycle would be if we just determine that, look, we can't, there's not enough energy to fulfill this demand. I mean, if we just can't produce the results that we want to get because we don't have the infrastructure, and particularly just the energy part of it, I think that would be a real crack in the thesis for what we are hoping it could be a huge AI boom for us. So I'd be looking at that as one potential outcome.
Ryan, we'd better jump. Thank you very much indeed for joining us.
Nice to see you.
Ryan Belanger, founder and managing principal at Claro Advisors.